Hi, everybody. I'm Jerry Cronenberg, Director of Financial Content here at Moo Technologies, Inc. And I'd like to welcome you to our latest live chat with our markets commentator, Sarge Guilfoyle. Steve, hello. Looking sharp.
Hello, Jerry. How are you?
Great. Looking sharp with the facial hair. So Steve is our market commentator here at Moo. You can check him out every single market day and invest with Sarge on the Moo community. See what he's thinking about markets and ask him a question. He's here to help you with investing by learning about lots of things such as technical analysis, options trading, and today's topic, one of our favorite economic indicators, job indicators. Now, this is a big week for job indicators. Earlier, we got the JOLTS report this week. As I'm speaking today on Wednesday, we just got the ADP private payrolls report. Tomorrow, we'll get the weekly jobless claims. And then on Friday, we will get the big report, which is the monthly jobs report from the U.S. Bureau of Labor Statistics. Now, the media cover these things, but no one ever really seems to talk about what exactly these indicators are, how you read them, what they mean, and more importantly, why does Wall Street even care at all? But Steve is here to tell you that today. Now, Steve is a former floor trader of the New York Stock Exchange, a staff economist, formerly of several financial firms, currently a columnist for the Street.com Pro, and I mentioned before, our own market commentator here on Invest with Sarge. So before we get started, Steve, let's encourage people to send questions. And now this is an interactive video. So use the comment function or the chat function of this video. Ask Steve a question. We'll try to answer them. If you send us a completed question, we will give you 100 Moo points just for doing so. If we use it on air, we will give you 1,000 Moo points in addition to that. So send those questions in now. Now, while we wait, Steve, let's get started. So big view from 10,000 feet. Of course, this is a big week for jobs data, but let's take the, as I said, view from 10,000 feet. Why does Wall Street even care? Why is this such a big deal?
Well, it's really, along with the inflation data, probably the most impactful series of numbers that we peruse, that we go over. And the reason Wall Street cares so much is because right now, growth and inflation are the two big topics that everyone's following, that everyone's watching to see if the Federal Reserve, the FOMC, will eventually reduce short-term rates or not. And these numbers really weigh heavily on the FOMC's decision on whether to do so or not. So if you have a strong economy that's producing a lot of inflation, that really goes against what the Fed's trying to achieve right now. The markets, whether it's good or bad for the economy, would like to see lower interest rates, lower short-term interest rates. So they're probably rooting for bad numbers right now, which goes against the grain for a lot of people. And really, anyone with a conscience, I think, would rather root for the human race and their gainful employment. But the numbers crunchers actually do kind of root against these series when we're at a pivot point as far as monetary policy goes.
Let's talk really briefly for some beginners. The markets, the stock market, I should say, tends to historically like lower interest rates. Right now, they're quite high. We're, I believe, in a 5.25 to 5.5% range on the short-term federal funds rate or target Fed funds rate. But they like lower rates. Just really briefly for beginners, why is that good historically for stocks, and higher rates are historically better for bonds and money markets?
Well, for a couple of reasons. Lower rates make credit cheaper. Many firms, such as small caps, rely on credit. The general theory is also that when debt instruments pay less, well, that forces investors into riskier assets, such as commodities, such as equities. So that's good for stocks, that's good for oil, it's good for copper, it's good for gold, unless we work ourselves into a recession, which would take away the commodities part of that trade, but you would still have the equities. So recession, although there's almost always an initial sell-off as in equities as we go into a recession, or once we realize we're in a recession, because we don't usually realize that in real time, the stock market tends to do well, even if economic growth is not there. If you're a study of U.S. history, U.S. economics, you see that after the great financial crisis of 2008, 2009, during the Obama administration, even though economic growth really never recovered. I mean, it was there, it was positive, but it wasn't tremendous. The stock market had a fantastic time for those 7 or 8 years. So it really, low interest rates are along with a few other things the Fed did, such as boost money supply, are good for equities.
Great. And just real quick for our beginners, equities and stocks mean the same thing. If not everybody knows that, we'll just clarify that. Now let's talk just a little bit about the Fed and the so-called dual mandate. The Fed, I've heard this 100 times, their mandate by law is to create maximum employment in the context of price stability, meaning high employment, low inflation. They have publicly said that their target of price stability is 2% inflation. I don't know that they've ever officially said what maximum employment is, but generally it's seen as around 5%. We're actually above that on inflation right now and below that on unemployment. The unemployment rate is lower than 5%. So again, the Fed does look at a number of economic indicators with respect to employment, right? So that is that goes into their decision-making of if they're going to cut rates, which a lot of Wall Street wants. Is it correct?
True. And it's difficult to know exactly what full employment is. That's why they don't come out with an official number, because for most of my career and your career, like you said, it was considered to be 5%. And we sailed right through that for most of the past, I don't know, 7 or 8 years, except for the pandemic era. It's really, unemployment's been below that. So maybe we should count folks that are marginally attached to the labor force. Maybe we shouldn't. Maybe that would give us a realistic view of unemployment. Maybe the underemployment rate, which includes people who work part-time but would like to work full-time, maybe that's a true measure of unemployment. I don't think even the most learned economists among us really know what full employment is.
Yeah, I've heard Fed speakers give speeches and they'll say something like, well, I look at 30 different measures of employment. Well, let's start talking about them. So today we got a big one, which is called the ADP Employment Report, or Private Payrolls Employee Report. For those who are unfamiliar, ADP in the United States is a major processing firm that gets your paycheck to you if you're a worker. So they measure how many people are getting paychecks. And they came out with a report. Again, it's only for the private sector, whereas the government report looks at people who work for the private sector and people who work for various government agencies. Came out weaker than expected today. 152,000 jobs added, whereas economists had mostly been expecting about 175,000 jobs. Let's talk a little bit about that report. What does that measure? Is it a good measure? Comes out 2 days before the government's own big monthly report. I've heard questions about whether it's good or not. Why don't you explain what that report is, what it tells us, and how people should look at it?
Yeah, it's really comparable to the private payrolls report that's released by the BLS on Friday. Which is most of non-farm payrolls. It's the vast majority of non-farm payrolls. And I think I like the ADP report. I think it's pretty accurate. They revised it about 1.5 years ago, and I think they really hit a home run when they revised it. I think it's been quite accurate since. A lot of folks think it's not accurate because it doesn't always match up with the non-farm payrolls report. But I look at it this way: the non-farm payrolls report from the household survey requires folks to answer the phone, folks to send in responses to the surveys. Same thing goes with the establishment survey, which gives you the employment number, because there are actually 3 numbers we look at in the space, but they're both from the BLS and they're both based on surveys. So how accurate can they be really? ADP is based on data. They cover, I don't know how much percentage of the private economy, but it's a good percentage, and they estimate the rest. And so I think, and plus I know the chief economist there, I think she's outstanding. I believe the ADP is a more accurate number than the non-farm payrolls. And I think the fact that the non-farm payrolls are so wildly revised after the fact, and for the last 1.5 years, that has not really happened to ADP. I think that I think that's the proof you need that the ADP is the more accurate number, although most economists won't acknowledge that yet.
Yeah, that's really interesting. I've usually heard people criticize it, not praise it. So let's talk then about the big one, which we will get on Friday. Comes out the first Friday, typically, of every month, unless there is a government holiday. And that is the Bureau of Labor Statistics, I believe is officially called the Employment Situations Report. It's sometimes called the BLS report or just the jobs report. There are a lot of components to that. It's closely watched by markets, comes out at 8:30 Eastern time, New York time, an hour before the market opens. Why don't you talk about what that contains and what markets look for and what investors might want to look at in that report?
It's actually 2 different surveys. It's the household survey where they call folks at home, where they send them mailings or emails, and they try to get responses out of them as to their situation on the labor supply side. And they also do the same thing with establishments. They have an establishment-based survey, and they don't really ever match up. I guess folks can hold more than one job. I know I have at times, so they would count as two individuals as far as these surveys goes if they were working two jobs. But this is how we get our non-farm payroll report, which is considered the headline report of the series. The unemployment rate is very important. The underemployment rate is very important. That's U6. Participation rate is important. And two other measures that don't really get a lot of coverage in the news, but the year-over-year wage growth number and the average work week, I think, are very important because they also relay a sense of whether there's a great demand for labor right now, or if there's too much labor supply based on how much folks are working. Because that average work week, they don't include the folks that are working 7 hours or 10 hours a week at Home Depot or at 7-Eleven. Those are full-time workers. So when you see that number tick down around 34.3 hours, that's really a negative for labor demand, because that means the full-time workers are working a little bit less than what we would consider a full-time week.
It's interesting. Now, of course, many Americans will look at the unemployment rate, which was 3.9% in April, again, below what is classically considered full employment of about 5%. But Wall Street typically looks at the non-farm payrolls, which is the number of jobs estimated to have been created in that month. Now, I've heard a rule of thumb is that if that number comes in at above 200,000, the economy is doing well. Below 200,000, the economy is weakening. Any thoughts on that? Is that correct, or what are your thoughts?
Yeah, I mean, that's traditionally been the case. Since the pandemic, the number's been so volatile that it's hard to stick to that. But there's no doubt that this series has been strong since the pandemic. And we're only looking for about 185,000 this month. But that number, while being strong on the first report, we've seen almost every month of the past year to year and a half, with a couple of exceptions, where the number has been revised down, not once, but actually for 2 straight months after the report. And it ends up being quite a bit lower than it was originally reported. The BLS also reported in April what they call their bed report. It tallies jobs a different way, and the BLS has informed us that they may have overstated non-farm payrolls by more than 1.3 million for the second and third quarters of 2023. So if that's true, if they end up revising non-farm payrolls that much lower for just a 6-month period, then basically you can throw all this out, because it would make it almost. It will still matter to the algorithms that control what you get on your trade, the price you get on your trade, but it won't matter to economists, because it will largely have been discredited if they have to revise by that much.
Wow, that's interesting. Now let's talk a little bit about what historically happens. Again, we're going to get this big report on Friday at 8:30 a.m., an hour before the stock exchange opens in New York. So what historically happens with stock and bond markets if this number comes out strong or if this number comes out weak? Of course, depends where you are in the economic cycle. Right now, we're in an economic cycle where unemployment is low, inflation is high. Other times we could be in the depths of a recession where the opposite is true. Unemployment is high, inflation is low. So let's talk first about the current environment, or the recent environment, the past few really years. Low unemployment rate, high inflation. What is going to typically happen historically if the number is strong or if the number is weak?
I think if the number is strong this week, I think they'll probably sell the market. And I think if the number is weak, they'll buy the market, based on what we were speaking about the Federal Reserve a little bit earlier. The market is probably hoping for something weak, but not too weak, because we've had for the last week or so, and going back further than that, but for the last week or so, we've seen negative or weaker responses, reports on almost every macroeconomic data point. And I think the folks are starting to become a little bit nervous about recession, a little bit nervous about even coming close to recession or stagflation if we can't get inflation to go away. So I think they would like to see a weak number that would provoke the Fed to go ahead with a first rate cut this year. But I don't think they want to see a number that's so weak that it rattles their cages as far as recession goes. We know that the Atlanta Fed, I think they just lowered their revision for their GDP model for the second quarter to 1.8%. I think they brought it down to. We know that the BEA revised the first quarter down to 1.6%. So this year is a slower year as far as GDP goes than 2023. I mean, if you want to get out into the weeds, I'll talk about GDI, which is a whole other ballgame and a whole other way of measuring economic growth. But for most folks who aren't at an advanced level, GDP is, I guess, what they go with. And clearly, this year is slowing down from last year.
Right, let's talk really quick about the bond market. That is the 10-year Treasury and maybe the 2-year Treasury. How does that typically react in our current era to a stronger than expected non-farm payrolls or a weaker than expected non-farm payrolls? What's the history of that?
Well, they'll buy treasuries if they think that the numbers weak, if they think that the labor market and the economy are weakening. They'll end up buying treasuries to get ahead of the Fed, and in the anticipation that the Fed would lower short-term rates. And conversely, if the number is let's say 300,000 or something for the job creation for this month, then they'll end up selling treasuries and forcing yields higher, because then they'll say, okay, now we know the Fed can't cut rates this year. Maybe they can't cut them next year. Maybe they even have to start talking about raising rates. So if the economy looks strong and the labor market looks strong, they'll actually sell treasuries.
Interesting. All right, I want to get to questions soon, but we're going to talk about two other indicators that either came out or are coming out this week. Earlier this week, we got the JOLTS report, Job Openings and Labor Turnover Survey, which also came in a little bit weak. Why don't you explain what that is, that indicator, and what it tells us?
Yeah, the JOLTS is actually, it's a measure of job openings and job quits that is released with a lag. This was an April report, so it has something of a lag to it. It's also released by the same Bureau of Labor Statistics, or BLS, as the monthly employment situation. And for April, we saw a pretty severe weakening in the amount of job openings. Now, technically, there's still more openings than there are people looking for work, but they brought it down to a little over 8 million, the number of job openings in the country, down from 8.3 something million for March, and they lowered March to that 8.3 something from 8.4 something. So really, they lowered 2 months in a row. They really brought 2 months below what they were expecting in a row for March and April. So that is supportive of the idea that maybe the labor market and the economy are weakening a little bit. The quit rate stayed at 2.2%, which is really the weakest number we've seen since 2018 outside of the pandemic era, which is a large chunk of that time. But if that number is actually low, that means historically that folks are hanging on to the job they have and not shopping around for something better. So it's actually another sign of labor market weakness.
That's cool. All right, we're going to talk about one more, which is going to come out tomorrow, which is every week on Thursdays before the market opens. The weekly initial filings for jobless claims benefits. When you get laid off, you file for unemployment benefits. Talk a little bit about that and what that tells us, what the market looks for, what investors may want to look for in that report.
Yeah, this is a compilation of the 50 state reports. The states do this on their own. The states pay folks unemployment benefits who get laid off at that level, and this is the compilation of the numbers from the 50 states. So it's not, even though it's released by the Department of Labor, it's not really a federal statistic, but it's a compilation of all the state level statistics. So what you're watching here is for the initial number, which has been very steady. It's been in the low 200s, basically for, I don't know, over a year, which is not really that bad of a number. It's a stronger number than you would expect, given how weak some of the other labor market numbers and economic numbers have looked. So that number has stayed relatively strong. Continuing claims have been around 1.7 million. That's folks who have been on unemployment for a time now and they haven't been able to find a job. Continuing claims do run out, so you can get thrown off continuing claims if you stay unemployed too long and you end up with no benefits. That happens to you, I think, after a year or so. I'm not sure about the number there, but continuing claims have been steady around 1.7 million, I would say, which is not really much of an indicator because that's really about where we were pre-pandemic. So that number has leveled off about where you would think it should level off. So folks are now watching the initial number, which to see if it takes off at all, given that some of the other numbers have come in weak, but so far it has not.
Wow. All right, now we're getting to my favorite part, which is our questions. We got a number of them in advance. Starting with our old friend, Mr. Cash Cow. Love this question. All right, my question is with regard to the stock market's reaction to unemployment news. Specifically, why is bad news usually good news for stocks? Many times I have trouble wrapping my head around this concept. Maybe you can help me better understand. Great question. So why don't you explain that?
Well, Mr. Cash Cow, I have been studying economics for about 40 years now, and I have trouble wrapping my head around that because it forces you to, in order to make money, it forces you to root against the human race, really, which I find difficult. And but you're right that if the Fed feels they have to rescue the economy, that's probably good for stocks because they'll have to take interest rates lower. So bad is good and good is bad at inflection points in the economy where there might be a transition from one phase to another in monetary policy. So yes, you are forced, if you are long the market, to root against the best interests of your human brothers and sisters.
Well, what can you do? Next question from Good Luck, Good Fortune. Let's hope we all have that. Two-part question. One, if there is a U.S. recession, what kind of indicators will be showing up on the jobs report before the recession hits? Great question.
Well, the funny thing is we don't really usually realize we're in a recession until we've already been in one. So we don't get much of a warning. The jobs numbers usually weaken ahead of in going into a recession, but we usually find that out on revision later on. It's rare that we find that out in time. The yield curve can invert ahead of a recession. That is a warning shot, but we've had an inverted yield curve for 2 years now, and the recession is overdue if that is truly an indicator. I believe it is an indicator. I'm not sure we're going into recession, but I'm pretty sure we're going into a much slower period of growth. And this inverted curve we have, 2s versus 10s, 3 months versus 10s, this is probably an indicator of this slowdown, even though it took 2 years to show up.
And just for those who are not familiar with it, the 2 to 10 yield curve inversion means you can get a higher interest rate on a 2-year Treasury bond than a 10-year Treasury bond, which tends to mean the market thinks that the economy will be slower in the future and inflation will be lower. And so you get better interest rates on the shorter term than committing your money for the longer term.
For instance, Jerry, the Fed funds rate, you said is 5.25% to 5.5%. That's an overnight rate.
Right.
The 10-year Treasury note pays, I think, 4.34% right now. So I mean,
right,
you get a better prorated rate on a one-night stay at the Fed, than you will for owning a Treasury for 10 years.
Exactly. All right, second question, good luck, good fortune. Whenever the latest jobs report comes out, there always seem to be some changes in the previous month's numbers. You were talking about this. So how accurate are these reports? What are your thoughts about that, Steve?
I believe they're highly inaccurate, to be honest with you. Really? I think we know the revisions that come, like you said, every month. They also come once or twice a year in mass, and they have backup studies like the one I mentioned earlier, the BED report, which show totally different numbers from the cumulative numbers of their monthly report. So when they have on the establishment side the non-farm payroll number, that's on the household side. On the establishment side, you have the employment total number, the total number of folks employed, and then you have the ADP report. So we'll have 3 different numbers for job creation for any given month, and it's not odd at all for all 3 to be in complete disagreement with each other. So yes, the market, what you have to know as a trader is the algorithm's response to the non-farm payrolls. So that might not be the most important number to an economist with an academic background, but that is the most important number for you as a trader.
Right. Next question. I love this one from DMDM. Why are farm workers excluded from the payroll indicator? Now, we always hear about non-farm payrolls, but why? What's so bad about farm workers?
Well, fortunately, they don't make up a great percentage of the number of workers these days, so it's not right. It's not a tremendous impact on the grand number. But in the beginning, the thinking was that they were largely seasonal workers, and so for that reason, they were left out of the count. I found out also when I was in the military doesn't count either. We don't count as, for some reason, the military doesn't count as government employees, even though they are. And so at one point during the great financial crisis, when everybody was doing whatever they could to make a living, I was working on Wall Street during the day. I was working at my local Home Depot at night and on weekends, and I was serving in the National Guard. So that was on other weekends and other nights and away in the summer. So I thought I was 3 payrolls, but I was only 2 payrolls because one of those was military.
Interesting. I forgot to mention your nickname is Sarge because you are a former U.S. military sergeant. Next question from Drift Along. This came in Chinese, but we translated it. Will the number of people filing for unemployment benefits for the first time affect the stock market? Now that's interesting because that number comes out every week. Most of these other numbers come out typically once a month. What does that indicator typically do? Does it impact the market or not, or a lot? Or what is
It can. It will definitely impact those trading futures at 8:30 in the morning on a Thursday. It will definitely impact those folks. And if the number is really out of whack, which we have not seen for a long time, so we don't have a lot of practice at this, at least not lately. But when that number comes in really, like, let's say 50,000 individuals away from the consensus view coming in, then you will see action, unless there's a more important number coming out that morning, but not likely. You will see the markets move once the bell rings at 9:30. But the futures market will tell you immediately.
Right. Next question from ZNWC. What type of stocks are sensitive to employment indicators? Again, historically, what's your view on that?
Well, I think the cyclicals will be much more impacted by the labor market. So that's that's energy, that's financials, that's discretionaries. It's those groups. It's away from the staples. It's away from the growth names, because the growth names are not as dependent on economic growth as are the cyclicals, and the defensives are actually considered to be resilient in the face of economic problems. So that's where a lot of folks will run. They'll run away from the cyclical groups into the defensive groups. So that's how we would expect Friday to play out if the number was weak.
And cyclicals are things such as, I want to give a few examples, not necessarily stocks, but sectors, the things that do better in a good economy and worse and ain't bad.
Well, like the discretionaries, energy, materials. I'm drawing a blank, but if I pull it up, I'm sure I can pull it up for you. Let's see here. We got the industrials, financials, energies, materials, and I think and discretionary. So you got 5 of them. All right. And it's 2 growth groups. That's technology and communication services. And the defensives would be the REITs, healthcare, the staples, and the utilities.
Because people need them, whether it's a good economy or bad economy. Need electricity, need to see the doctor. We're going to squeeze one more question in here from I Love Soya. All right, are the data being factored in before the actual announcement? Now, of course, everybody knows we're going to get this big report on Friday. We got one this morning. Have they already been factored in by the time you get the numbers out? What's your thinking on that?
To a degree, I believe that there are folks that are gambling on or playing the number. And if it lands right on consensus, in theory, it shouldn't move anything, but it almost always does. So there are folks that will play the number. I don't think anyone has enough faith in it to really know for sure what comes up on Friday, because while the non-farm payroll number has been accurate, like I said, it's almost always been revised. The participation rate moved around a little bit. Average work week has been weak of late, but wage growth has been kind of strong. So they kind of counter each other. It's very difficult to play these numbers ahead of time, but there are indeed folks and algorithms that will try to do so.
I'm going to squeeze one last thing here from Bright Hamster 2313. Are these lagging indicators of the market? Of course, we'll get the May payroll numbers. It's going to be June 7th, so it's at least 7 days after May, and then it's 38 days from May 1st. And as you said, they're revised. So are these lagging indicators, or are they fairly up to date? What's your thoughts on that?
Oh, these are definitely lagging indicators. The numbers are pretty much compiled for non-farm payrolls and for the other numbers in the BLS report within the first 2 weeks of the month. So really, they're not just a handful of days late. They're almost a month late. They're like 3.5 months or so late, which is fast in survey terms. But that's also another reason why I like the ADP number more, because it's data, it's fast. I mean, if they can figure out what you looked at on the internet today and try and sell it to you tomorrow, I don't know why they can't get these numbers right. Surveys are no longer the right way to do this, but they're not convinced yet.
Interesting. All right, that is it. So we're all going to watch on Friday for how the report comes in, the big jobs report, and we'll be talking to Steve again for more things about the market. But in the meantime, feel free to check it out, check him out at Invest with Sarge. That is his handle on the Moo community. He is there every day to help with your investing journey. Steve, thank you as always. And everybody, thanks for tuning in. Happy investing and have a great day. Thanks for watching.